Okay, so let's unpack this. There is a phrase that gets thrown around a lot in history books, usually right before things go, completely sideways.
Right.
It shows up in old movies, usually in some dark, dusty tunnel. The canary in the coal mine.
Yeah, it's a super vivid image.
It really is. It's this tiny, fragile bird, bright yellow, sitting in a cage deep underground. And it is literally the only thing standing between a group of miners and an invisible, silent death.
Usually carbon monoxide or methane.
Exactly. Because the bird's metabolism is so much faster than humans, so it reacts first. As long as the bird is singing, you are safe. When the bird stops singing, or, falls off its perch,
You don't ask questions.
right, you just run.
It is a powerful metaphor for an early warning system. It's about detecting toxicity in your environment before you can physically feel the effects yourself. Because by the time you actually feel dizzy, it's usually too late.
Exactly. And the reason I am painting this picture for you today is that this deep dive is centered around a source material that uses that exact metaphor. But we aren't talking about coal mining
No.
or air quality. We're talking about the global economy. Specifically, we're looking at gold.
And the premise here isn't just that gold is shiny or that it makes for a nice watch. It's that gold is the alarm bell.
Right.
And according to the conversation we are unpacking today, that alarm isn't just ringing, it is screaming.
It really is. The source actually describes the current state of the world and the financial system specifically as alarm phase red 5.
Yeah, that is not a subtle designation. That is very much get to the lifeboats kind of language.
It totally is. So let's set the scene for you, because the context here is everything. We've gone through a stack of materials, but we're primarily centering this deep dive on a fascinating and honestly somewhat terrifying interview from a Dutch channel.
Right, it's called De Springplank voor Vertrek.
Which translates to the springboard for departure.
Which already sets a certain tone, doesn't it?
It really does. The interview features the host, Pim den Rijswijk, speaking with Paul Buitink. Now, for those of you who don't follow the European precious metals market, Paul Buitink is the director of Holland Gold.
He's a heavyweight in this space.
He is. But here is the twist, and this is crucial for everyone listening to understand. The conversation takes place in early 2026.
Yes. This is effectively a future history perspective for us. They are referencing an upcoming event in June 2026. So the source material is looking back. They're reflecting on the years 2024 and 2025.
And that context changes literally everything, because when they talk about gold prices, they aren't talking about the slow, steady creep that investors in, say, 2023 were used to.
No, not at all.
They are reflecting on a period where the markets went completely off the rails. They're describing a world that has seen extreme volatility.
Precisely. And the mission of this deep dive is to decode that sudden explosion. We really need to understand why it happened, according to the source. What does a vertical gold price signal about the health of the dollar, the euro, the whole banking system? But more than that, this source material is incredibly practical.
That's what I loved about it. It's not just some high-level economic theory. It's almost a survival guide. We aren't just talking about inflation curves. We are talking about actual tradecraft.
Tradecraft is the perfect word for it. It answers the gritty questions. How do you test if a coin is fake without a laboratory?
Yeah.
How do you hide wealth in your house so a burglar doesn't find it? How do you smuggle assets across a border if the laws just change overnight?
It's like a mix of an economics lecture and a Jason Bourne novel.
It really explores the Plan B mindset, the idea that you need to be prepared for a scenario where the normal rules of society just stop applying.
So let's not waste any time. Let's jump straight into Section 1, the gold rush of the 2020s. We need to look at the numbers, because this is the canary they are talking about. Walk us through the data described in the source.
Okay, well, the picture Paul Buitink paints is one of a market in a state of absolute mania. If we trace the timeline he lays out, we start at the beginning of 2024.
Okay.
At that point, a kilo of gold was trading at around 60,000 euros. Now, put yourself in the shoes of an investor back then. 60,000 euros felt expensive. It was all-time high territory.
Right. I remember people back then saying, it can't go much higher. It's topped out.
Exactly. But fast forward just 1 year to the start of 2025. The price had hit 80,000 euros.
Wow.
That is a roughly 30% increase in a single year. In normal financial markets like stocks or bonds, a 30% gain is incredible.
Yeah, that's usually a decade of returns compressed into 12 months.
Right. But in the context of what came next, that was really just the warm-up act.
Okay, so we're at 80,000 euros in early 2025. The canary is singing pretty loudly now. Then comes the real shock.
By the start of 2026, the price hits 120,000 euros.
Unbelievable.
And then in January 2026, just a single month, it shoots up to 150,000 euros per kilo.
Let's just pause and let that sink in for a second. From 60,000 to 150,000 in roughly 2 years. That is not a bull market. That is a vertical takeoff. It's an exponential curve.
It is, and Buitink points out something very important about curves like that. It's exhilarating if you own the asset. You feel like a total genius.
Oh, sure.
But it's terrifying if you understand what it actually means. Because assets like gold, which are effectively dead rocks that don't pay dividends, they don't usually do that unless the currency they're denominated in is in serious trouble.
That's a crucial distinction. It's not necessarily that gold is worth 3 times more. It's that the euro or the dollar might be worth that much less. Or the public's fear regarding the currency has tripled.
Exactly. It's a pure reflection of confidence collapsing in the paper money system.
And what I found really interesting in the source is how this price explosion changed the people who were actually buying. There's this stereotype of the gold buyer, right?
Oh, absolutely. The classic image is the gray old man or the tinfoil hat conspiracy theorist who thinks the world is ending next Tuesday and has a bunker full of canned beans.
Right.
That has been the demographic niche for a long, long time. But Buitink describes a massive shift during this rally.
Yeah, he says it went mainstream, but not just investment portfolio mainstream.
No, it became dinner table mainstream. He talks about awake entrepreneurs. These are business owners who are looking at their cash reserves and realizing that inflation is just eating them alive.
They aren't conspiracy theorists, they're pragmatists.
Exactly. They see the cost of materials going up, they see their purchasing power going down, and they move into gold purely to preserve capital.
But then, during that mania phase in January 2026, when the price hit 150K, he describes something else entirely. He describes regular citizens just panic buying.
That is the FOMO, fear of missing out.
It's dangerous, isn't it?
It is pure psychological contagion.
Yeah.
He describes people buying without understanding what they are buying. They just see the news, they see the graph on the screen going vertical, and they think, I need to get on this train before it leaves the station.
Which is always a bad sign.
Right. That is a classic sign of a mania phase. When your neighbor, who has never invested in anything but a basic savings account, suddenly wants to buy gold bars, you know the market is overheating.
And inevitably, when things overheat, physics takes over. What goes up must come down. Or in this case, crash. The source details a pretty nasty correction right after that peak, didn't it?
It did. After hitting that dizzying height of 150,000 euros, the price dropped sharply back to around 137,000.
Okay.
Now, that is still way up from the start, but that is a very quick 10% haircut. And silver took an even bigger hit. Silver plummeted from over 3,000 euros per kilo to below 2,200.
Wow, that is a brutal drop if you bought at the top.
It is.
So if you were one of those panic buyers in January, you instantly lost a significant chunk of value. You're underwater immediately.
Correct. And this brings us to the whodunit part of the story. Why did it crash so hard, so fast? The source presents two theories, and I want to unpack both of them because they really show the difference between normal market logic and what we might call conspiracy realism.
Right. Let's play skeptic versus believer here. The first theory is just standard market mechanics, right?
Yes. Theory one is a natural correction. Nothing goes up in a straight line forever. When an asset rises 50% or more in a short period, people take profits. It's gravity.
Right. The buyers run out of steam, the sellers step in to cash out their winnings, and the price finds a new equilibrium. That's the healthy, organic explanation. Occam's razor says this is usually the case.
But Buitink doesn't seem entirely convinced that it was just nature taking its course. He hints at something a bit more coordinated.
And I have to ask, is this just sour grapes? Like, oh, the price went down, must be the bad guys manipulating it? Or is there actual substance to this claim?
It's a completely fair question, but there is substance to the mechanics he describes. He suggests the possibility of institutional manipulation. To really understand this, we have to look at the difference between the physical price and the paper price.
Okay, break that down for us. What exactly is paper gold?
So, the physical price is what you pay to hold a physical bar of metal in your hand. But the global spot price of gold is largely determined by the paper market. These are futures contracts traded on stock exchanges like the COMEX in New York.
Okay.
These are contracts promising to deliver gold or just betting on the price movement.
And there's a lot more paper than actual gold.
A massive amount more. The ratio of paper gold to physical gold is huge. Buitink suggests that large institutions or bullion banks may have been hurting from those really high prices.
Why would they be hurting?
Well, if they were short on gold, meaning they bet the price would go down, they were losing billions as it went up to 150K.
Oh, I see. So they are bleeding money. How do they stop the bleeding?
They can dump massive amounts of paper contracts onto the market all at once. We're talking about selling the equivalent of global mining production in a matter of hours. And since it's just paper, they don't need the physical metal to do it.
Right.
This massive sell order drives the price on the screen down dramatically.
So they flood the market with phantom gold to crash the price.
Exactly. And because the paper market sets the spot price, the physical price follows suit. Buitink argues that a 30% drop in silver or a massive correction in gold in such a short window smells like a washout.
A washout.
Yeah, it's a deliberate move to trigger stop-loss orders from regular retail investors, drive the price down, and allow the big players to cover their short positions or just buy back in at a discount.
It's the classic shakeout. The regular people who bought at the top panic and sell, and the big institutions swoop in and buy it up cheap.
It is a tale as old as markets themselves. But Buitink makes a key point here. Even after the crash, the price was still significantly higher than it was a year prior. So the macroeconomic trend remained intact. Even if the volatility burned some people, the canary is still singing the alarm. Even if the volume dipped for just a moment.
And that trend is what we really need to focus on, because even if the price was manipulated down, the fact that it went so high in the first place signals something deeper. Which brings us to section 2 of our outline, the why. Why is gold acting like this? The source calls it a barometer of stress.
Think of gold as a thermometer for the geopolitical and financial fever of the world. Buitink mentions that historically, central bankers, even the ones who publicly dismiss gold as a barbarous relic, they check the price of gold first thing in the morning.
Really? Like who?
Alan Greenspan was famous for this. Why? Because gold has no counterparty risk. It doesn't rely on a government's promise or a company's earnings report. It is pure value. So when it spikes, it means trust in everything else. Dollars, bonds, euros, it's all falling.
And who is doing all the buying? We talked about the Dutch citizens earlier, but on a global scale, the source points a very big finger at China.
China is the absolute elephant in the room. They have been accumulating massive amounts of gold for years now. And this is highly strategic. They are actively trying to de-dollarize.
To reduce their dependence on the U.S. financial system.
Exactly. By building up their gold reserves, they are strengthening their own currency's backing.
Yeah.
They're essentially saying, we don't trust the dollar anymore, we trust gold.
But there is an interesting nuance in the source about silver regarding China. They love gold, but they have a very different relationship with silver. This really caught my attention because I always assumed they just moved together.
That was a fascinating detail, and it explains a lot of the weird market dynamics. Buitink notes that China does not want high silver prices.
Why not? I mean, if they want precious metals, wouldn't they want all of them to go up?
No, because for China, silver isn't just money. It's an industrial ingredient. Think about what China dominates globally. Solar panels, batteries, electronics, all of these require silver. It is the most conductive metal on Earth.
Ah, so it's a cost of doing business for them.
Exactly. High gold prices boost the value of their reserves, which is great for their central bank. But high silver prices increase their manufacturing costs, which is bad for their export economy.
That makes total sense.
So while they might encourage a high gold price, they have a strong incentive to keep silver suppressed or at least stable.
That's a really helpful distinction for anyone wondering why silver doesn't always move in lockstep with gold. It has an actual job to do in the economy, whereas gold is mostly just money.
Exactly. Gold is the currency of last resort. And speaking of last resorts, the interview goes into a pretty dark but necessary thought experiment. Pim van Rijswijk asks, what happens if the financial system actually implodes tomorrow?
The system implosion scenario. This is the stuff of nightmares, but we have to look at it. They paint a pretty vivid picture of the domino effect.
They do. And it's not just theoretical. The source explicitly references historical precedents like Greece in 2015 or Cyprus in 2013. Remember when people in Cyprus woke up and were limited to withdrawing 50 euros a day?
I remember the photos of the lines at the ATMs. People were desperate.
Now imagine that, but everywhere, and with zero withdrawals possible. The source argues that logistical chains would collapse almost immediately. We live in a just-in-time world. Supermarkets hold about 3 days of food.
3 days.
Yeah. Gas stations rely on electronic payments to order their next tanker truck.
So if the digital money system stops,
The trucks stop, and if the trucks stop, The shelves go empty within 72 hours. It is that fast.
And in that vacuum, what happens? We just go back to the Stone Age?
Not the Stone Age, but we return to barter. And this is where the argument for precious metals comes in practically. In a total collapse, you need a medium of exchange that everyone recognizes and trusts. You can't easily trade a cow for a tank of gas.
Right.
You need something divisible and portable. Gold and silver coins bridge that gap before a new currency is established.
Buitink mentions the new golden concept here, the idea that the government should have a backup currency ready, but he doesn't seem to have much faith that they actually do.
No, he is quite critical of the government's preparedness. He argues that while they push emergency kits with water and radios for citizens, they have completely failed to secure the financial system or prepare a monetary plan B, which leaves the responsibility entirely on the individual.
This is the core of the prepper mindset or plan B thinking that runs through the whole episode. It's about sovereignty. But there was a really important point made about community, too. You can't just be a lone wolf with a safe full of gold sitting on your porch with a shotgun.
That is one of the most insightful points in the source. You can have a freezer full of food and a safe full of gold, but if you don't have neighbors you trust, if you don't have a community to cooperate with, you won't last long.
Yeah.
Security isn't just about walls and weapons, it's about relationships. In a crisis, your network is just as valuable as your net worth.
That's a powerful takeaway. It's not just about hoarding, it's about building resilience. But let's say you do want to build that resilience by owning some gold. The source pivots in Section 3 to some very practical tradecraft, because apparently, as the price of gold goes up, so does the creativity of scammers.
It's the inevitable side effect of a bull market. Counterfeiters see an opportunity. The source warns specifically about high-quality fakes. We aren't talking about chocolate coins wrapped in gold foil here. We are talking about advanced metallurgy, specifically tungsten.
Tungsten? Why tungsten? Why not, I don't know, lead or steel?
It comes down to physics, specifically density or specific gravity. Gold is incredibly dense, about 19.3 grams per cubic centimeter. It's almost twice as heavy as lead.
Wow.
Yeah, so if you made a fake gold bar out of lead, it would have to be nearly twice the size to weigh the same. Anyone holding it would know instantly it felt fluffy or light.
Okay, so lead is out.
But tungsten sits at 19.25 grams per cubic centimeter. It is almost identical to gold in density. It is nature's cruel joke on the gold investor. If you take a bar of tungsten and coat it in a thick layer of real gold, it will weigh almost exactly the same as a pure gold bar. It feels right in the hand, it looks right, but it's worthless on the inside.
That is terrifying. You could buy a gold bar for 100,000 euros, and it's actually a 50-euro doorstop wrapped in 500 euros of gold leaf. So how do you avoid getting scammed?
Well, the first rule is the venue. Buitink warns against buying from private sellers on marketplaces. They mention Marktplaats, which is the Dutch equivalent of Craigslist or eBay.
Right.
Even if they have a receipt, receipts can be faked. You need to go to a reputable dealer.
But let's say you are in that crisis scenario we talked about earlier. You're trading with a neighbor or someone in a market. You don't have a professional dealer nearby with an X-ray machine. The source describes a low-tech field test you can do, the ping test.
Yes, the sound of money. This is a skill everyone should probably know. The physics of gold and silver are unique. They resonate in a very specific way. Buitink describes bouncing a coin on your fingertip and tapping it gently with another metal object.
And what are we listening for exactly?
You are listening for acoustic resonance. Real gold and silver sing. It's a high-pitched, resonant sound that decays slowly. It goes vying.
And a fake.
A fake, even a tungsten fake, has a different internal lattice structure. It absorbs the energy differently. It sounds dead. It makes a dull thud or a clunk. It doesn't vibrate.
So ring equals real, thud equals dud.
Essentially, yes. It's the difference between tapping a crystal wine glass and tapping a plastic cup. Obviously, professional dealers use spectral analysis and electronic scanners that verify the chemical composition to 99.9% accuracy, but in a pinch, your ears are your first line of defense.
I love that. It feels very old school, like something a merchant in the 1700s would do. Now let's move to Section 4. Logistics. You've got the gold, you've ping tested it, it's real. Now where do you put it? The source calls this hiding in plain sight.
This is a great discussion on the psychology of theft. The natural instinct is to buy a big, heavy safe and bolt it to the floor. And that's not bad advice. But Buitink points out a problem. Burglars know what a safe looks like. It is a giant magnet for attention. If they break in, they go straight to the safe. If they can't open it, they might wake you up and threaten you until you do.
So what's the alternative?
Deception. He suggests having a decoy safe, a safe that is relatively easy to find, maybe just in the master bedroom closet. Inside, you put a little bit of value, maybe some cash, some jewelry, maybe a few silver coins.
Just enough to make it look real.
Exactly. Give them a win, they break it open, they grab the loot, and they leave, thinking they scored. They don't want to hang around.
Smart. Meanwhile, the real wealth is hidden elsewhere. And this is where the cookie tin strategy comes in.
Right. He mentions people hiding gold in biscuit tins or in random household items. A burglar is unlikely to rifle through your pantry looking for bullion. They're looking for cash and electronics. Hiding in plain sight relies on the fact that gold is small. You can hide a lot of value in a very small space.
Yeah.
A tube of gold coins fits inside a curtain rod. It fits inside a hollowed-out book.
I love the curtain rod idea. That's super clever.
However, Buitink, being a dealer himself, does argue that professional storage is ultimately superior. Bonded warehouses, insured vaults. It removes the risk of robbery and the stress of literally sleeping on top of your wealth. But for the hardcore prepper, having at least some access at home is non-negotiable.
Right. I want a stash you can grab if you have 5 minutes to leave.
Yeah.
And that brings us to the most Jason Bourne part of the source material, moving gold across borders. The source gets really specific here about the difference between moving around Europe and trying to actually leave the continent.
This is crucial knowledge for anyone with that Plan B mindset. Inside the Schengen zone, which is most of the EU, it is surprisingly easy. If you are driving, say, from the Netherlands to Spain or France to Italy, you can have gold in your trunk. There are no permanent border checks. It's just cargo. It's your property.
I ain't flying.
Flying is also relatively straightforward within the EU. If you are carrying under 10,000 euros in value, you don't even have to declare it. If you have more than 10,000, you have to fill out a declaration form for customs. But, and this is key, usually no tax is due. It's just a registration to prevent money laundering. You declare it, they stamp the form, and you walk through.
Okay, so Europe is easy. But the source brings up a specific destination that seems popular with Dutch immigrants. Paraguay.
Yes, Paraguay is mentioned as a hot spot for people leaving the system. But here's the problem. Leaving the EU with gold is hard. Not because of leaving. Customs in Europe will usually let you leave. But because of arriving.
Ah, the destination customs.
Exactly. If you show up at Asuncion Airport with a suitcase full of gold bars, the customs agents there are going to have a field day. They might confiscate it or charge you massive import duties, sometimes 30% or more. You basically lose a third of your wealth just by walking through the door.
So you definitely can't just walk through the green channel.
Definitely not. So the source discusses a hack. And I want to be clear to you, the listener, this is described as a very risky, unofficial method. This is not legal advice. It's a report on what is being discussed in these circles. They talk about the household goods method.
This is the container strategy. Walk us through this scenario.
Okay, let's role play this. You are moving to Paraguay. You have the Plan B mindset. You have 5 kilos of gold, which is nearly €1,000,000 at these 2026 prices. You can't carry it on the plane. So you look at your shipping container, you have a couch, a dining table, boxes of books, kitchenware.
Just the stuff of a normal life.
Right. The suggestion discussed is hiding the gold inside that container, mixed in with the general household goods, maybe taped inside the bottom of a drawer, or hidden deep in a box of pots and pans.
The logic being that customs officers don't unpack every single box of books.
Precisely. It's a volume game. They rely on scanners and dogs. Dogs are trained to smell drugs and cash. But as the source notes, there are no gold-sniffing dogs. At least not yet. Gold has no scent.
It's a huge gamble, though.
Massive gamble. Imagine the stress. For 3 weeks, while that ship is crossing the Atlantic, you are sweating bullets. If the container is lost at sea,
Or falls off the ship.
or if Customs does decide to do a random deep search, if they find undeclared bullion, you are in serious trouble. Your insurance likely won't cover undeclared gold hidden in a sofa. So it's a high-risk, high-reward maneuver for those desperate to move wealth without government eyes on it.
And for those who don't want to play smuggler, there's always shipping. But even there are traps. The source compares using generic couriers like FedEx versus specialized transport.
And the difference comes down to chain of custody. Buitink explains that within Europe, they use FedEx successfully for smaller amounts, but there's always a risk with generic couriers. We've all had packages tossed in a bin or left with a neighbor we don't even know.
Your package was left behind the flower pot? No, thank you. Not for a kilo of gold.
Exactly. Think of it like the difference between ordering a pizza and transporting a prisoner. When you order a pizza via a generic courier, the driver focuses on speed. He might leave it on the porch. Specialized gold transport is like a prisoner transfer. Two guys, armored vehicle, signed paperwork at every single handover, GPS tracking. The driver often doesn't even know what the item is, just that it is high value. It's a completely different level of security.
Let's zoom out a bit. We've covered the how, buying, testing, hiding, moving. Now let's get back to the why on a macro level. Section 5, politics in the future. The source material is pretty blunt about the state of the euro.
Blunt is an understatement. Paul Buitink essentially predicts the slow death of the euro. He argues it is fundamentally unsustainable. It lumps together economies that are just too different, like Germany and Greece.
Right.
It causes inflation, it requires transfers of wealth that Northern Europe presents, and he argues it leads to a loss of national freedom. He foresees a euro crisis 2.0.
He seems frustrated that the political will isn't there to fix it or leave it. He talks about Nexit, a Dutch exit from the EU, but admits it's not happening anytime soon.
And this feeds into a broader political disillusionment in the source. There is a deep discussion about the cartel.
The cartel, that's a loaded word.
It is. It's a term used to describe the established political order. The source argues that even new populist parties, they mention BBB or NSC in the Netherlands, they often rise up to capture angry voters. But eventually, once they get into power, they just become part of the system. They call it controlled opposition.
So the idea is that the faces change, but the policies and the allegiance to the euro remain exactly the same.
Exactly. It's a very cynical view of democracy. They actually compare it unfavorably to places like Singapore or China in terms of planning.
That's a controversial take.
It is, but here is the logic they use. Western democracies are paralyzed by short-term election cycles. Politicians only think 4 years ahead. How do I get reelected?
Right.
Meanwhile, authoritarian or semi-authoritarian states like the Gulf nations or China can plan 20 or 30 years ahead. When you are dealing with multi-decade economic shifts, the source argues that the long-term planners have the structural advantage.
And that advantage is frightening if you are stuck in the short-term system. Now, looking forward, what are the triggers? What pushes us from alarm phase 5 to full-blown catastrophe? The source identifies a few geopolitical flashpoints.
The biggest one is war. The source views a conflict involving Israel, the U.S., and Iran as almost inevitable in this timeline. They see this as a major potential trigger for the next massive spike in gold prices. War is expensive, and war destroys trust in paper money.
And on the flip side, there's the war on cash.
This is the idea of financial repression. The source advises keeping cash at home because bank access isn't guaranteed. They see a push towards digital-only currency, like CBDCs, as a way to control the population. If your money's just a number on a government server, they can turn it off. If you have cash or gold, you have freedom.
And interestingly, they do give a nod to Bitcoin here.
They do. Buitink acknowledges Bitcoin as digital scarcity. Despite its extreme volatility, he sees it as a valid alternative to the system alongside gold. It's another way to opt out.
So we've covered a massive amount of ground today, from the price explosion to the fake coins to the shipping containers to geopolitics. As we wrap up, let's do a rapid-fire recap based on the yes-no round from the interview. I'll ask you the question. You give me the source's verdict.
Let's do it.
Cash in the house.
Yes. Always have liquidity on hand.
Gold at home.
Yes, but keep it small.
Yeah.
Don't make yourself a target. Use the decoy safe.
Crypto.
Yes, as a
On
diversifier.
our bank safe.
For now. But don't count on it forever.
Is the Netherlands, and by extension Western Europe, still an attractive place to live?
For now, but alarm phase red.
Hmm.
Enjoy it, but have your running shoes and your springboard ready.
Alarm phase red, it really sticks with you. You know, the source mentions this beautiful concept that gold is frozen energy. It's labor and value trapped in metal that can't be deleted or inflated away.
And that leads to the final provocative thought I want to leave the listener with. We live in a world of screens. Your bank account is pixels. Your stocks are pixels. Your deed to your house is a record in a database.
Right. It feels real until the screen turns off.
Exactly. If the screen goes black, if the power goes out, or the internet goes down, or the server crashes, what do you actually own? What can you touch? The source is arguing that if you can't hold it, you don't really own it. And in a digital world, physical ownership is the ultimate rebellion.
That is a heavy thought to end on. Mentally decoupling your survival from the system's stability. That's the plan B.
Exactly. You don't have to leave the country to leave the system. You just need to own things the system can't touch.
And on that note, we're going to wrap up this deep dive. Thanks for listening, and until next time, keep your eyes on the canary.
Stay safe out there.